So in 2020, we've seen historically low mortgage interest rates. We've seen inventory in the real estate market drop by 20% or even higher in some markets. And we're seeing homes sell for $30,000, $40,000, even $50,000 above list price as buyers are literally throwing money at a house in order to get their offer accepted. So obviously, this is not sustainable, nor is it healthy for an economy or a market. And there's a lot of experts who are predicting we're going to see a real estate market crash sometime in the near future. So today I want to run through what I think are the 5 most likely scenarios which could cause the next real estate market crash. But quick side note, I want to explain why something could cause a real estate market crash. So all markets come down to supply and demand. Currently we have incredibly low supply and a huge demand. So in order for us to see a market crash, this ratio needs to flip. We need to have far more sellers than we do buyers in the market. So anything that could dramatically increase the number of sellers in the market could cause a housing crash, or anything that dramatically reduces the number of buyers in the real estate market could cause a crash. And there are some very likely scenarios that could do either of those things. So the first possible cause of a real estate market crash would be if the Federal Reserve raised mortgage interest rates. So earlier in 2020, the Federal Reserve lowered their federal funding rate, which is essentially the rate that they lend money to big banks, and announced that they would be buying mortgage-backed securities. These two elements have caused mortgage interest rates to dramatically drop and then continue dropping month over month for most of 2020. And this is the biggest reason why we have so many buyers in the real estate market right now. So the Federal Reserve is essentially a building in DC filled with the smartest accountants and economists in America, and they operate separately from the executive office. So no matter who the president is, they will not have direct control over the actions of the Federal Reserve. They operate independently. And it's entirely possible that the Federal Reserve accountants are looking at all the negative consequences of the current housing market. So they could look at the fact that homes have become more unaffordable for first-time home buyers, or the fact that the average family in America is now spending a larger portion of their monthly income on housing expenses because home values have gone up, or the fact that everybody's property taxes are going to be going up over the next few years. They could look at all these negative consequences and say, hey, we need to slow down this market. And they could decide that they're not going to buy mortgage-backed securities anymore, and that they are going to raise the federal funding rate. Both of these things would cause mortgage interest rates to rise, and we see the number of buyers in the market dramatically reduce. And reducing the number of buyers in the market could cause the next real estate market crash. The actions that the Federal Reserve takes over the next 12 months is going to have a direct impact on the number of buyers in the real estate market, and why we need to watch their actions so closely. Now, the next scenario is that the vaccines are very effective and very quickly our country reaches that level of herd immunity. If that happened very quickly, we could see huge impacts in the real estate market. In 2020, there's literally millions of homeowners who did not sell their homes even though they wanted to because of this virus. If suddenly this virus was completely eliminated, we reached herd immunity, all those millions of homeowners who did not sell their homes, they're all going to sell their homes at around the same time. Now, all those homeowners who did not list in 2020, they're not going to sell their homes evenly distributed over the 12 months of 2021. There's typically a selling season where the majority of homeowners put their homes on the market, and we see a huge spike in inventory typically in the springtime. So if these vaccines are very, very effective, and by, let's say, March of 2021, we've reached that level of herd immunity, we're going to have the millions of homeowners who did not sell last year all put their homes on the market in the springtime of 2021. And this absolutely could flip that ratio to the point where we have more sellers in the market than we do buyers, which could cause the next housing market crash. Now, if this vaccine is effective, but we don't reach that herd immunity level quickly, let's say in 3 months, but instead it takes us 12 months, or maybe it takes us by the end of 2021 in order to reach that herd immunity level, it is still going to have an impact on the number of homes for sale in the market, but it won't be as dramatic. And that surge of inventory probably will be more spread out next year rather than all condensed in the springtime. So again, it's something that we need to watch very closely over the next few months. Now, the next scenario could be that banks tighten up their lending requirements. There's a couple of different factors that banks look at when they decide if they will lend you money and how much. One of them is going to be your income level. They also look at your debt to income ratio, so how much debt you have compared to your income level. And of course, they look at your credit score and your credit history. These factors and a few other ones will determine if they will qualify you for a mortgage and how much. There's a lot of banks out there right now who are really hurting because they have all these homeowners who are not making their mortgage payments, and those banks cannot foreclose on those homeowners because of the federal foreclosure moratorium. So these banks are just losing money every single month because these homeowners are not paying their mortgages. There's also currently 2.8 million homeowners who are in forbearance, which essentially means that they don't have to make mortgage payments and they tack those payments onto the end of their 30-year loan. So that's 2.8 million loans that those banks are not making any money off of. So it is entirely feasible that these banks are losing so much money that they decide to tighten up their lending requirements and only accept clients that they think are a very good chance are not going to get foreclosed on and not file for forbearance. So if a bank used to qualify somebody for a mortgage with a 600 credit score, they could say, you know what, now we are only accepting people with a 700 credit score. If banks used to require at least 2 years of consistent income, they could say, you know what, now we want 3 years of consistent income or 4 years. If they used to say that we want a 30 to 70% debt to income ratio, now they could say, you know what, we want a 10% to 90% debt to income ratio. If they do any of these things to make it harder to qualify for a mortgage, that could dramatically impact the number of buyers in the real estate market. And those actions very well could cause a real estate market crash. So the next scenario is the foreclosure crisis. So the foreclosure crisis is a very real thing, but how big and how impactful it's going to be is still kind of up in the air. So currently we have a federal foreclosure moratorium on all government-backed loans, and this covers 70% of the mortgages out there. And many states have expanded this to cover conventional loans as well, but that is on a state-by-state basis. At some point, those moratoriums are going to come to an end, and banks are going to be allowed to foreclose on homeowners again. And what we're going to see is all the homeowners that would have been foreclosed on anyway during that period, they're all going to get foreclosed on at the same time. Plus, we most likely are going to see a surge of additional foreclosures because of this virus. Now, how many additional foreclosures we're going to see is tough to say, but there are a few metrics that we can look at. One of them is the unemployment rate. At the peak, we saw an unemployment rate at 15%, currently sitting around 7%. But truthfully, unemployment levels may not always be the best indicator to look at, because we do have a lot of people who went back to work, but they're still underemployed. They're working reduced hours and not making nearly as much money as they did last year. Another metric that you can look at is that we currently have 2.8 million homeowners in forbearance. So this means that they can defer their monthly mortgage payments for up to 12 months and essentially tack it on to the end of their 30-year loan. Now, out of those 2.8 million people currently on forbearance, most likely many of those people only filed for forbearance out of a precaution and not because they absolutely had to. So when the forbearance plan does ultimately end, it's tough to say how many of those homeowners will ultimately get foreclosed on. Could be 500,000, it could be 1 million. Another factor that you need to look at is how many millions of landlords are out there right now who their tenants are not paying their rent, and those landlords cannot evict those tenants. I wouldn't be surprised if a lot of those landlords just said screw it and stop making those mortgage payments and are just letting their home go into foreclosure. So most likely when the foreclosure moratorium and the eviction moratorium and these forbearance plans all end, we are going to see a huge spike in foreclosures. That could ultimately lead to a huge surge of inventory in the real estate market like we saw in 2008, and depending on how many buyers we have in the market, that could cause the next real estate market crash. The next scenario is that the government could deliberately cause the next real estate market crash. So like I said earlier, there are a lot of negative consequences to an economy when home values go up this much this quickly. Homes are becoming less and less affordable for first-time home buyers. Many homeowners are now spending a larger portion of their household income on housing expenses, and everybody's property taxes and insurance on those homes is going up. Canada has actually been dealing with this exact same problem in their housing market. In the last 15 years, home values have tripled in Canada, and currently the average home value in Canada is $600,000. And the Canadian government has actively taken steps in order to try to crash their real estate market and lower home values. And it's entirely possible that the US government takes similar actions to try to lower home values and keep homes affordable. For example, they could tighten up the minimum requirements on federally backed loans like the VA, USDA, and FHA loans. One thing that they could do is eliminating or altering the capital gains tax. So currently you have to live in a home for at least 12 months in order to qualify for the long-term capital gains tax. Anything shorter than 12 months and you have to qualify for a short-term capital gains tax, which is much higher. If they change these requirements or lowered capital gains tax, we could see an increase in inventory in the real estate market. Another thing they could do is tighten up the requirements on federally backed loans like the VA, FHA, and USDA loans. Many of these, you only need a 500 credit score in order to qualify for them. If they increase that requirement to, let's say, 600 or 650, 700, we would see a reduction in the number of buyers in the market. They could also incentivize builders to build new homes and communities by reducing taxes or just making that process easier for them. And this is actually part of Joe Biden's housing plan, is that he wants to incentivize builders to build more affordable homes, like in that $150,000 to $200,000 price range. If over the next 12 to 24 months we suddenly saw a huge surge in new construction inventory, that absolutely could slow down the growth in the housing market or even crash it if they're not careful. It is totally feasible that the federal government could step in to try to slow the growth in the housing market and lower the average housing cost. And frankly, there are some strong arguments of why they should do that. If you haven't seen my video breaking down my 5 predictions that I'm very confident we're going to see in the housing market in 2021, you can check that out right here. Don't forget to subscribe for more real estate and financial advice. Thanks so much for watching, and I'll see you over in the next video.